Hey, what's up guys? This is Chris Steves with eXp Realty in Ottawa, and going to dive into some numbers and do an analysis on a fairly common real estate investment strategy here in Ottawa, taking an old bungalow and converting to 2 legal units. It's something that a lot of people have done very successfully in the past. It was a very lucrative investment strategy. But that was when prices were cheaper and interest rates were lower. So we're going to look at some numbers and see if that's something that's still doable in today's market. So let's dive into it. So here we go. Going to break down, this is a spreadsheet I put together to give us an outline. Duplex, secondary dwelling unit, the BRRRR approach: buy, rent, renovate, refinance, repeat. Let's see if these numbers are going to make sense, guys. Okay, so kind of looking at 2 scenarios. Number one is a long-term tenant strategy, and then the second option being a more shorter-term furnished room rental strategy. We're going to break down the numbers on both and see which one's better, see if either of them makes sense. So option 1, here we go, 625. Yeah, I think we can buy these things still at 625. Prices have come down. There are a few out there that are, fairly attractive, and pricing is typically going to be kind of six to 700,000 for these things, depending on where and what it is. But I think we can get something decent that works at 625. Yeah, maybe you can get it lower if you can. That's amazing. Obviously you can spend more on them. But for the sake of this example, 625 purchase price, closing costs $84.50. That's land transfer tax and legal fees approximately. Rental costs, okay, so this one's a bit more of a gray area. I put in 140,000, so you're gonna have to gut the basement, and you want to separate the utilities, the hydro, the heating. If you want to do it right, you got the full basement. You're gonna end up doing some work to the main floor as well. I'm gonna say 140,000 based on my experience and working with different crews. If depending on who your connections are and can you cut enough corners, etc., you can get this number down. Certainly can go above this budget. So again, for the sake of using a fairly approximate but fairly realistic number, 140,000, that's not gutting the main floor, that's just doing some updates to the main floor. So you're going to have some carrying costs during the construction period. You're going to be paying your mortgage, your utilities, your property tax, your insurance, etc. So there are carrying costs. We're going to say it takes you about 4 months to do this renovation. That can certainly go over time. Depends how good you are and how on top of the management you are. Ideally, it doesn't take the full 4 months, but here we are. So 790,000 all-in costs, and now you've got 2 legal units. They're very nice units. The basement's all brand new, everything. Separated some of the utilities. We're going to say main floor, you're getting $22.50. What we're doing here, I should have highlighted, what we're doing here is a 3-bedroom, 2 full bathroom unit on each floor. So main floor, 3-bed, 2-bath, $22.50 in rent, very doable. Yeah, that number could be higher, number could also be lower. It's going to depend on the location and how nice your spot is. But I think this is a decent number to use as an example, and I think it's reasonable. Downstairs unit is all brand new everything, even though it's a basement apartment. 3-bedroom, 2-bathroom. I think you'll be able to get 2,100. Sure, maybe you could push that a bit higher. It can certainly go lower. You list that for 1,900. It's obviously going to rent out a lot quicker. But we need these numbers to be high to make this scenario work. So this is what we're going to use for income. Total annual income, $52,200. It's very good income for one of these buildings. Property taxes are going to be, so breaking down the expenses, let's find out what our net is. Property tax is $4,900. That's approximate. It's probably fairly accurate for one of those bungalows. That will go up over time. Insurance, $1,850. I think that's fairly accurate still. Maintenance, so we're factoring what, 5%. So 5% of your income goes towards maintenance. This is a pretty new renovation, and everything's going to be in pretty good shape. So you could argue that you don't need any kind of maintenance and repairs expense, but to be a diligent investor, you gotta, you should always factor this in anyway, because every few years you're gonna have to replace things, and it's better to have accounted for that. So anyhow, utilities, gas. You separated the heating. Tenant's gonna pay the gas and the hydro. There's different ways to separate heating, but we can kind of leave that for another video. Water, sewer, we did not separate the water sewer line, so it's just one. So the landlord's going to pay for the water sewer, and that is what it is. So management, did not factor in any management fees here. But again, this scenario is the long-term tenant scenario. We're going to say you're able to manage this yourself. It's not too much work. So we're going to be generous and say we're not factoring any management expense. Although, to be a kind of prudent investor, you should put in a management expense. You should really have at least 5% in there. But we're going to skip over it for this time. Vacancy and loss, 3%. Again, you always get, every once in a while you'll get some downtime. You get a month where it's not rented out, so you need to account for that. Every year you can run into that. Vacancy rates in Ottawa are probably something like 2% across the board. So 3% is kind of fair. I think I should probably also mention that I think that a lot of lenders, when you're financing an investment property like this, they would factor the certain numbers into their equation when deciding how much mortgage and what to lend. And I'm not a mortgage broker, but I think they would do something like 5% maintenance and repairs, 5% management, and 5% vacancy and loss. So anyways, keeping that in mind. Anyway, here we go. We got a net income of about $40,000 after our expenses. Gives us a cap rate of 5, which is decent for Ottawa for a nice building, that's all renovated. That's very, very good. So anyway, we get into the, this is the BRRRR part of the equation where we refinance. We did the buy, the renovate, the rent. Now we're refinancing. We need an appraisal. We're going to have to figure out how much this is going to appraise for, and having been through a few of these across Ottawa, I think you're going to be able to appraise something like this one with this income. I think that getting it appraised at $850 is safe. Depends on what appraiser you're using, and again, a lot of different factors are coming into play here, but I think $850 is safe for this. There are certainly units like this that have sold for higher than $850. Obviously, there's a ton of them that have sold for less. But I think that's a fair number. Fair number for this example. So here we go. We're refinancing. This is our newly appraised amount. We're going to refinance 80% of that. So that's $680,000 we're pulling out. So, we were all in for $790,000. We just pulled out $680,000 of that. We got $110,000 of our own money left in the deal. Something that worth noting here is, after doing a lot of construction and a lot of work for many months to get this place updated and stabilized, you spent $790 to get there, and now it's worth at least $850, probably more, to be honest. But you've already made money just in the fact that this place is worth a lot more than it cost you to renovate and build. So, you know, with this BRRRR investment strategy, the ideal goal is when you refinance here, after everything's stabilized, you refinance, you pull out 100% of your initial investment. And you know, certain investors, that is their objective, but it's very, very hard to do in Ottawa, and very hard to do with this investment style of this bungalow conversions. I've looked at the numbers on tons of these things. I'd be impressed if you could still pull this off and refinance and get all your money out of the deal. Anyway, so now we got $110,000 left in the deal. We got a mortgage of $680,000. Interest rates are going up tomorrow, September 7th, by the sounds of it. I put in a debt service interest rate 4.75 here as an example. I think, well, today, I think that's very doable to get that interest rate, but we'll see what happens later this week. Anyways, for sake of example, 4.75 interest rate, you're spending about $46,000 a year on your mortgage on this amount here, which is considerable, but you've got very good mortgage pay down here every year, so that's very attractive. This is where the challenge sets in. The cash flow monthly. You are negative $532 a month on this, and you know, if you didn't refinance a full 80%, if your mortgage here got smaller, this number gets a lot better very quickly. So, I mean, again, do you want to refinance the full amount of 80%, or do you want to maybe only do 70 or 60%? It's really up to you. You can, really any deal, you can get positive cash flow if you put enough money down, but you know, that's ideally not the goal, is to put all your money into one deal like this. So something worth noting is the mortgage pay down monthly is over $2,000. So yeah, you lost $500 on the cash flow, but you're paying your mortgage down. You're still getting positive returns every year, and your cash on cash ROI is, you know, around 17%, which is excellent. Keeping in mind you got 110 grand in the deal, and you are making money every month. So there is decent ROI on this. You have built in some equity because you were able to do the project at you know, below the future appraised value. So you've got equity already in the deal once it's all rented out. I like these things. Honestly, I think they're great investments. It's nice to see you've got a pretty healthy net returns. You've got good income coming in. It is a bit frustrating not to have positive cash flow, because that's what everybody wants, but there's still some other pluses and upsides to this type of deal. So, scenario 2, you know, most of this is the same. We are going to do furnished rentals per bedroom, and we're going to do 4 bedrooms on each floor. And yes, you can pull that off with most of these bungalows. You're going to be able to get, you know, they're usually about 1,000 square feet per floor, and you can squeeze 4 bedrooms into there if you're very careful with your design. It's usually doable. So I did inflate the reno cost here up to $190 because you will need to gut and renovate both floors for this type of project. There's really no way around that. I mean, unless you find a really big bungalow, but you won't get that for $625. So rental costs are going up because you're fully renoing both floors. You're changing everything. I put the timeline to 6 months of construction period here before you get it rented out. And there is also the cost of buying furniture. So I just baked that into the reno cost here. So you got to buy furniture, you got to furnish the whole place. Now your all-in cost is $843,000, but you're getting a lot more in rent because you're renting per bedroom. Ideally you rent for 1 year, You get all these tenants in each floor to sign the same lease, and we're going to say $750 per bedroom on the main floor, $700 in the lower unit. These are fairly accurate. I mean, yeah, there's some people that would argue you can get more money for each bedroom, which you probably could, depending on your location. But again, for argument's sake, for this example, we're going to keep it conservative here. 69,000, almost 70 grand gross income per year is very, very good. I mean, you can see it's a lot more than the 3-bedroom rentals over here. So you got big gross income, but your expenses have gone up a little bit. I'm going to say insurance, well, maintenance is definitely higher. You've got 8 tenants now with furnished units. They're going to put a lot more wear and tear on everything. So get ready, your maintenance and repairs is going to be more money. I put insurance up a little bit as well, just because it's a different type of rental property, and your insurance company would probably charge you more based on that. So get ready to pay a bit more on that. Gas, you have not, you as the landlord are paying all the utilities. These tenants are paying an all-in rental cost. So the tenant or the landlord has to cover these utilities expenses. So your expenses actually have gone up quite a bit here for this type of rental. Again, you're paying the sewer and water. I put a management fee in, 8%. Yeah, I mean, listen guys, if you can find a it's hard to even find a management company that will do this type of rental and manage this type of project. So I really feel like we need to put in a management fee here. It's more work to deal with individual tenants doing individual room rentals, and there's going to be higher turnover. So get ready for more work. You may want to pay someone to help you out there. Vacancy loss, I kept it at 3%, just for the sake of argument. I think it's doable anyway. But now your net is 45,000. You're still netting more money. Your cap rate is higher. So this scenario here is more work, it's more time, it's more overhead. But at the end of the day, you are making more money, the returns are better. Now we're going to look at the refinance process. Ideally, you're going to get this thing appraised at a lot more than over here. This one generates a lot more revenue. Yes, in Ottawa, there are a handful of these things that have sold, you know, mid-900s. I think we even had 1 or 2 that broke $1 million last year. So, yeah, I mean, this future appraisal amount, this is safe, I think. This is fair. This could be higher, and if it is higher, that's a win. Let's look back here. So we spent $843 to get here, to get this all fully renovated. This is essentially a brand new building. And now we're refinancing for $921. So you've already made equity on this deal. You're going to pull out 80%, $737,000. Now you got $106,000 of your original investment left in the deal. So, but I mean, here's the challenge. Now you got a bigger mortgage amount. Again, with these interest rates, it's you know, it's tough. You know, it's the mortgages and financing has gotten more expensive. But your principal paydown's getting bigger. Your negative cash flow got a little smaller, thankfully, so this is getting a little better. So these numbers are looking more attractive. You're paying more of your mortgage down. Your principal on your mortgage is getting paid down every month, so this is getting better. Keeping in mind, here's your initial investment that you have left in this deal. So your cash on cash return is, you know, 21%. Very, very good. I mean, you got an excellent building. You got, it's fully renovated. Ideally, you shouldn't have any, you know, you shouldn't have much repairs and maintenance for the first 5 to 10 years, ideally, depending on what you built. But I think these are attractive investments. I mean, you know, it just, again, you got that negative cash flow, but other than that, if you're willing to look past that, you know, you're getting some equity right off the start, because once this thing's all done and renovated, it's, you know, the value is going to be up quite a bit. The rental income is really big, and the mortgage pay down is very strong as well. So all in all, I think this is a great investment. You know, there's a lot of ins and outs to these things. I know this is a very kind of general overview. Really, it takes a lot more time to really dive into all the ins and outs and the expenses. You need a team of the right people. You're going to want to have, you know, people that know what they're doing with these things. You can run into a lot of issues and hurdles. These things can run over budget and they can run over time really quickly. So something else I advise is don't go into one of these with you know, underfunded. You really want to make sure you've got the financing. I don't recommend over leveraging yourself, just because you know, there's always variables that are unforeseen, and these things might not go, they rarely go exactly as planned. So I think it's really important to make sure you got your financing, you're ready to take on a deal this size, and you're kind of ready for a plan A, plan B, plan C, you know, just in case things don't go perfectly. But all in all, I think these are a very good investment, and the income's excellent. And you know, if you have the time and you want to, you know, put the effort into to do one of these projects, I think you're going to be happy. I think you're going to make money. So there you have it, guys. If you have questions or you want to chat about this stuff, call me anytime. You can reach me on my website, chrissteves.ca. You can email me, chris@chrissteves.ca. But I'd love to hear from you, and always happy to have a conversation. Thanks, guys.